will give you money for. And it only ultimately gives you the opportunity to take that money and deduct that money. So it's a huge benefit.
So it would be the equivalent of me spending Ryan's money.
Correct.
Oh, yep. I like it.
Is that the case usually, Melissa?
No, not usually, not enough, I should say. Okay, so if that is what depreciation is, then what is a cost segregation study, and how does that really come into play with depreciation?
So what a cost segregation study is really, it's segregating the asset. And so that's all it's doing. So when you buy a piece of real property, and this is going to get as technical as I want to get, it is called a 1250 asset. It's a real asset. And under 1250, an asset has three designations. It's land and non-deductible, it's commercial real estate and it's deducted over 39 years, or it's residential real estate and it's deducted over 27 and a half years. What a cost segregation study does is it takes that 1250 asset that you bought and it pulls out tangible personal property. And so what you're doing is you're taking the tangible personal property, which is anything that, the way I like to say is anything that you can pick up and move is tangible personal property. So refrigerators, dishwashers, cabinetry, carpet, all of that stuff is considered tangible personal property. And as such, it's shorter life. And so ultimately we're taking that and we're segregating it out from the long life assets, which gives us the ability to depreciate it over a shorter time period.
That was perfect. Y'all, sometimes this explanation can go right over any of our head. So that was perfect, Tim. He also, one time when we were first looking at, this was a while ago, I called Tim and I asked, okay, what simple terms, what is a cost segregation study? And he told me it's a powerful way to maximize depreciation deductions and minimize the tax burden for commercial property owners who acquire or develop real estate. Now that stuck with me. So that is a easy way, Tim, thank you for that explanation, because it does get confusing. It can get pretty technical. So I appreciate that.
Definitely can.
Yeah, for sure. So if we're here talking about obviously accelerated depreciation and cost segregation study, most of our investors, we get questions all the time about 1031 exchanges. What are we doing a 1031 exchange? Can we 1031 exchange into our fund, our current fund? So one of the things that I would love to discuss is the benefits of a cost segregation study, and then kind of pair it and really show the pros and cons of a 1031 versus a cost segregation study. So first, let's talk a little bit about the benefits.
So ultimately, by segregating things out, now we've got more things to play with.
Hang on, Tim, can I interrupt you?
Go
Why
for
are
it.
we even talking about 1031s? They suck, right? You know, 1031 suck. We should focus on what the benefit is of cost segregation. No, I'm just kidding. I would love to hear the explanation, but Tim gets it. I think there's just a huge misunderstanding of truly what 1031 is, right? And what other options are out there. I think if other people, which is the point of this, is if other people knew the other options, they would always go with the other option, right? 1031s are so misunderstood, I think. I don't know. Sorry, Tim.
No, it's fine. And everything has its time and place. I think there is a time and place for a 1031 exchange, but that time and place, especially after 2017, has become very fleeting. And it might come back into play after 2026. Who knows? Yeah. But ultimately, I mean, the benefits of a cost segregation study is now we've got all these balls. We had one ball that we could juggle and we couldn't do much with it. Now we've got 5-year assets, we've got 15-year assets, we've got 27.5-year assets, we've got 7-year assets, and we can kind of juggle them and we can look at, okay, well, what do we need? What do we need from a deduction standpoint? You know, prior to 2017, when we didn't have bonus depreciation, we would play the game of saying, okay, well, what do we need? Do we need a lot of deduction this year, or do we need deduction next year? Maybe we'll stack everything into the next year and we'll use nothing this year. So we'll just take everything over current depreciation rates, and then we'll bring all the accelerated deduction into the current year. With the 2017 Tax Act, and the introduction of bonus depreciation on used assets, well, now that was a huge game changer, because by doing a cost segregation study, all we're doing is we're taking the 1250 asset and we're pulling out short-lived assets. Well, short-life assets by design are available for bonus depreciation. So now every asset that we pull out, we can deduct immediately. So in a situation, let's just say a garden style apartment complex, we've got this situation where, let's say 30% of the assets are short lives. Well, now we can write those off immediately. And so that's a huge game changer, especially if you're using leverage, because leverage is typically somewhere between 70 and 80%. Well, in that situation, if you're putting $1 in, you're getting $1 deduction. I mean, the benefits of a cost segregation study far outweigh anything else.
And I think there's a lot of misconception on whether passive investors or only the active investors can participate in this. What is your say on that?
Everyone participates in it. There's been a lot of misnomers. I know a lot. Back in 2017, I had a lot of sponsors that had come to me and said, I don't really want to pay for a cost segregation study because my passive investors aren't going to be able to use it because of past activity loss rules. Well, you don't know what other investments your passive investors have. So in a year that you create a huge passive loss, they might have had huge gains. 2021 was a huge year, huge capital transaction year. I had a lot of clients that were selling for 2x gains, and they used passive activity losses that they had held on to or got in prior years to offset all those gains in 2021. So yes, they might not be able to immediately use them, but those losses carry forward indefinitely until they're no longer around. So they will be able to use them at some point.
And what I hear from that is that we as the passive investors have that control back. We get to decide, instead of with the 1031 saying, okay, eventually someone, whether it's my posterity, my whatever it is, they are going to pay my tax bill eventually. With a cost segregation, I get to decide. I get to completely eliminate that in year one or spread it out whenever I need to. I have that deduction to be able to put into play. That's one of the most valuable aspects for me, is I get to be in control again.
Yeah, and I mean, with the 1031 exchange, it's so restrictive and your hands are tied so tight by the rules and regulations of what you have to follow. And one of the biggest things you have to follow with the 1031 exchange is every dollar has to go into that exchange. And if you take $1 out, that dollar is immediately gained. So it's not a hybrid of gain and basis, it's 100% gain. So if you are doing a 1031 exchange, and let's say you've paid down the debt, I mean, let's say you've had this property for 10 years and you've paid down a third of the debt, and now you're going to have a gain of 100,000, but you're going to get $150,000 of cash. You have to put $150,000 into your next deal in a 1031 exchange to avoid taxation. If you use a cost segregation study, you only have to put $100,000 in and make sure that the debt is 70%. And boom, you get $50,000 to invest in something else. Do something else with. Put it into a new house for yourself. Put it in a vacation house. Go to Hawaii. Whatever you want to do with it. Or
reinvest it with us.
Yeah. No, 100%
Either one. That actually is perfect, because that fits right in with this slide here, talking about some of the frustrations that we hear over and over again with 1031 exchanges, and ultimately is what helped us make a decision with the last 5 properties that we exited and not doing a 1031 exchange, because they are so restricted. Like you said, you have to find an exact property, a like kind property, but then you also any amount that is not rolled right over into the new property, you're still taxed on.
Yep. So and there's restrictions on when the exchanger can give your money back. They're going to hold on to your money for 6 months and a day, even if you've got a blown 1031 exchange, because they don't want any exposure on their end. And so you've got this very tight window of 45 days and the 180 days to close. If you don't identify properties within 45 days, the 1031 is blown. But if you've given your money to an exchanger, they're going to sit on it for another, 4.5 months until they give it back to you. So now you're in limbo. Where with a cost segregation study, all you have to do is put enough capital back into a deal before December 31st of that tax year and make sure that they're doing a cost segregation study. And that's it. That's all you have to do.
Okay, so there was one question Daniel asked in the chat. He said land, which was the second one you said, residential. What was the second type? I honestly didn't catch it in time, but I don't know what was
Commercial real estate.
Oh, okay. That was a simple question.
Non-residential.
Okay. For a second, I'm like, wait, did I miss a part of a conversation? That's perfect. Thank you. Another question from Al, I believe, or AI, either one, whatever his name. It says basis limitations. Do you want to give more? Respond in the chat what you're meaning there.
Yeah, I mean, there could be basis limitations, but yeah, give a little bit more detail on that, please.
Perfect. Now, I want to kind of break this down. So as a passive investor, if I have invested, say I exit a property and my capital gain is, obviously I know every situation is different, y'all, every situation. And it obviously comes off of your own tax situation. But just theoretically, if I exit a property and I have a $300,000 gain and I decide to roll 200,000 of that into a deal where they're doing a cost seg, what does that look like as a passive investor?
I mean, in that scenario, you would have, if you rolled $200,000 and it was a traditional multifamily, you would expect somewhere between 25 and 35% right off in the first year. So if debt was 70% financing, you could expect if you put $200,000 in and the cost say produce a 30% write-off, you would get a $200,000 write-off in that first year. Now, there are some differentials. Properties bought January 1st, you're going to have a year of income. Bought December 31st, you're going to have no income. So there are a little bit of ebbs and flows in there, but really that's what it comes down to. And your example brings up a critical point. When I do tax planning, I talk about being as efficient as possible. Well, the first $80,000 of capital gains is taxed at 0%. So if this is your only income for the year and you don't really want to put $300,000 into it, let's say you want to hold $100,000 back. Well, okay, you put $200,000 in, that's wiped off by the cost segregation study. You get $80,000 in change in 0% capital gains. So that's wiped off. And you're married, you get $25,000 standard deduction. Well, guess what? You've now taken $300,000, you permanently eliminated tax on 100 of it, and you've used a cost segregation study to eliminate the tax on the 200,000.
I love it. It's awesome.
With a 1031 exchange, you couldn't do that because that $100,000 you kept out would have been taxed.
Y'all, this is why you have a conversation with a professional. Okay. I know that there are a lot of people on this webinar that have spoken to Tasha or I, and we have said, listen, we're not a tax professional. We're not an accountant. Y'all, this is why you make sure that you are partnered with people that have experience doing these kind of things, because it will absolutely benefit you in more ways than you can even imagine. But also, let's address this. I have lots of investors who will say, listen, my accountant is adamant that as a passive investors can't benefit from cost segregation studies. My answer is always, you may have outgrown your accountant, and that's okay. That's a good thing. But if your accountant isn't familiar with this, then maybe it's time to change accountants to someone who has experience with commercial real estate and cost segregation studies. Do you see that often, Tim?
Yes. Yes.
Okay.
It's just, yeah, I mean, I see it a lot, and unfortunately, there is a mindset and a shift in mindset or a context shift. And, unfortunately, a lot of times people say, well, it's passive losses, you're not going to use it. You don't get any benefit from it. That might be true now, but you're not proactively looking forward. And, I look at a passive loss as, hey, I don't get to use it, but it's an opportunity cost. I have it now. And if I didn't do a cost segregation study, I don't have it. So what happens if next year I have an investment that sells for a $200,000 gain, and I had an opportunity for a $200,000 passive loss in the current year that I could have carried forward to next year to offset that gain? Well, I don't have it now. So by saying I don't have it is just a loss of opportunity, in my opinion.
That right there, you nailed it. That is why we are so passionate about this opportunity. Investors say all the time, well, I don't know if I need it right now, but you might. We never want to play and roll that dice. We want to make sure that we capitalize on all tax benefits for our investors, even if you decide not to use it. We want to make sure that it's there so that you can win and if you need to.
Agree.
All right, there are a couple other questions as well. So it says, when is the cost segregation study initiated? Is it after the sale? I'll let you answer that, Tim.
It is. It has, the only requirement for a cost segregation study is it has to be completed by the due date of the return it is used on. So prior to 2017, we did a lot of cost segregation studies, and we would hold them because we were able to ultimately utilize them to pull the deductions into a current year. And so we would deduction stack using cost segregation studies. That might be something that we do after 2026 if bonus depreciation actually goes away. But all the requirement is that it has to be done by the due date of the return that it's filed on.
Perfect. Okay, Kate has this question. She said, is real estate professional status requirement of 750 hours for all properties you owned combined, or does that 750 hours per building? And what about 500 an hour material participation requirement? Is that also 500 an hour requirement per building, or for all buildings you have combined?
If you don't make the election, the 469C7 election, it's for every single activity. But there is an election under 469, which is the passive activity loss rules in the code, that allows you to group all rental real estate into one activity.
Perfect. Okay, and then Amir asks, does cost segregation apply to stabilized properties or value add properties?
Either.
Perfect. All right, Casey asked, you mentioned that 1031s might make a comeback after 2026. What triggers might make the 1031s come back? And under what increasingly rare circumstances are 1031s good for?
So if bonus depreciation goes away, and it's a sunset provision, so it's slotted to go away every 5 years. It's been in existence since 2002. They continue to kick it down the road. If it actually makes its way and sunsets, then you'll see 1031s come back into prevalence, just simply because it's a way to defer tax. And in the second question, to answer that, is if you're going to a different class. So you're selling a multifamily and you're buying a piece of land for speculation. Land doesn't depreciate. That would be a good opportunity for a 1031 exchange because you can't offset it with depreciation. Or I'm selling on a property. I'm selling a property on December 1st. 1031 exchange probably makes a lot of sense because it gives you 5 months into the next year to find a property. So there's some instances where it does make sense, but in most situations, if you've already found the property, you're going to be able to get it closed by December 31st, that, a 1031 exchange doesn't make any sense anymore.
Perfect. Hopefully that answers. The other question is, when using a cost segregation plus bonus depreciation, do we still have depreciation recapture at sale? Meaning it's still only a deferral and not elimination of taxes.
It is, but it's an arbitrage. So what you've got to look at and what you've got to think about is when I go back to the beginning, I talked about what depreciation is. It's just deducting the asset over its useful life. So the IRS says carpet's useful life is 5 years. After 5 years, it's worthless. Refrigerator, 5 years. Land improvements, so sidewalk, asphalt, 15 years. So depending on how long the property has been held for, we can look at the remaining useful life of those assets, and we can recapture depreciation based on their remaining useful life. So if we've got an asset that we've held for 5 years, all the 5-year assets are now worthless. So we have no depreciation recapture on those. We've got 2/3 left of the 15 years, and then we got the 27.5 years, which doesn't have the same type of depreciation recapture. But so, yes, there is depreciation recapture, but by doing a cost segregation study and then actually doing a study of the remaining useful life, we can mitigate the amount of ordinary income recapture that we have at sale.
Perfect. So Christopher just asked this, and it's a great question. He says, so when I sell an asset and I take the proceeds, as long as I invest those proceeds into another deal, into another deal that does cost segregation, I won't pay the capital gain?
Yes, with the caveat that you've got to talk to who you're working with to know what the deduction is and what the debt is. And I know this from experience because I had a client that had a lot of people invest in a property in Tennessee that was a 10-story complex. Well, the depreciation was only 20%. It didn't have the garden style. It didn't have the land improvements. It didn't have any of that. And so the deduction in the first year is 20%. They had 70% financing. And so instead of getting a 1-for-1, they got about a 60% deduction. And so a lot of people were really upset about that. And, you know, the issue there was not communication that was going to be the case. So you just need to communicate with the sponsor. What is it? What is the, what's the leverage? What is the expectations from the cost segregation company of what the deduction will be on this property?
And this is a perfect example of why you want to work with experienced operators. If an operator has experienced 1031 or cost segregation exchanges before, oh my gosh, cost segregation studies, I'm not going to join them together, cost segregation studies, if operators have that experience, then they're going to understand what those regulations are. They're going to know what their property is going to typically go for. So that for me is why it's so important to vet the operators and understand who is the managing partners on the deal. You want to make sure that they're experienced for that exact reason.
I tell my clients all the time, you're not investing in the property, you're investing in the sponsor. Wholeheartedly, sponsor A and sponsor B could take the same property and have the complete different results.
That's why, Ryan, you need to smile right now, okay? You are the sponsoring party right now. No, I feel incredibly lucky to have such an amazing team here at MF Capital Partners. I'm very grateful for that exact reason, because I agree with you, Tim. It really is a matter of not when, but but when curveballs actually happen. And if it's not the right team, then the property will struggle, no question.
I think, Melissa, to the point, Gene is on here who's invested several times with us. In fact, he said he's invested in the fund, and the purpose of putting these on is, right, we have a fund. And, Tim oversees that fund and his team as well. But, he says he may have, outgrown his accountant. And Tim, I'm sure you'll laugh at this. It is. You see a lot of accountants that just don't know how to apply this to your tax, to your taxes, or that you're structured correctly, or that you can carry it forward, like Tim said. A lot of, the good things with getting a good CPA, and Tim, maybe you can allude to this, is forecasting, letting them know what's going on, when you're going to sell the property. Is it going to be sold in 2023? What's going on in 2022? Did you do a cost segregation? What makes more sense? Can you carry it forward? Should you carry it forward? Now, I know that was a lot, right? But the title of this is how to eliminate paying taxes on your investment gains. And unless you have a qualified accountant or CPA that can walk you through that, right, you're paying taxes where you shouldn't have to pay taxes. Also, you're putting your money into investments where potentially You could place them in other investments of people who are a lot more transparent, where it's not like this deal. And I think you said 10 Minnesota, that's a 10-story that was only 60%, right? Maybe it's 70 or 80% that benefits you. You know, I know in every single one of our deals in the fund, you know, I think they're above 70% on there. And so what does that do for you tax wise? Man, if you make good money, that's where you eliminate those taxes or carry them forward for like a sale of a property. We just sold off, you know what, 5 different properties in the last month, you know, and some of those returns were phenomenal in a short amount of time. You know, one of our properties were only owned for 9 months. What's that mean? That's 40% in capital gains right now, Tim, right? Or something, somewhere around there, right? You know, and so the reality is those gains are going to be high. So, you know, those investors are all investing into our fund so that they don't have to pay, right, that capital gains, because that could be a steep capital gains. But anyway, yeah, I don't know if you want to touch base on that, you know, Tim, but yeah, you need to get a qualified accountant, especially when you're dealing with this kind of stuff.
Yeah, I mean, the most important part with an accountant is someone that actually talks to you and asks questions. You know, I could get on a soapbox and talk for 10 hours about our industry, but unfortunately, our industry is predicated like everything else right now. It's all about monetization and about how many tax returns can you get done and how much turnover there is or velocity in that. And so a lot of times CPAs don't want to talk to you. They don't want to sit down and have a planning meeting. They don't want to do that simply because that means they can't do another tax return. And that's where the monetization of their firm comes from. And so really just, you know, you want to sit down, you want to make sure that they're going to answer your questions. You're going to want to make sure that they're going to ask you the questions that need to be asked. A lot of times, and like Ryan said, that they're being proactive and planning with you for what you're doing today and 5 years down the road. You know, a lot of time when we do year-end planning, we sit down and we look at where are you today? How have you planned for today? But what's happening next year? Because I don't want to over plan for this year and ultimately end up screwing you next year and having you pay higher taxes because I over planned this year. So what can we do to pull in expenses into the current year or revenue into the current year, defer into the next year? But ultimately, we want to make sure that we're planning appropriately. And so I think it's very important that you make sure that you're working with someone that is okay talking to you and is okay to pick up the phone, is there for you, is, you know, available for you when you need them.
And on that note, last time we did a webinar like this, Tim was absolutely bombarded with our investors that wanted to talk with him about going over their own in their own taxes. So Tim is not your guy. He has a whole team at his firm that will work specifically with you. So if you're interested or looking to transfer accountants, this is how you would contact them. You'd go to provisionwealth.com and click contact in the top right corner. So just to make sure there aren't any confusions, Tim is our accountant. He works with more multifamily syndications, funds. That's where really his realm, but then he has a whole team of people that work with individuals or passive investors. So his firm can absolutely help you, but it won't be Tim. So if you're looking, there's a place for you right there. But what Ryan touched on, if you're interested in, you know, working with operators who have the ability to help eliminate your capital gains and have that experience, here's a QR code. If you want to take a screenshot of this, this will absolutely take you right to where our current fund, and you can place a small reserve. Let us know that you're interested in what you're thinking, and then we can jump on a call. Or you're welcome to click a link that we have in the chat that Tasha is dropping over there as well, whichever way. Most importantly, we want to make sure that we give you opportunities to really take advantage of these tax benefits. There are so many available. Make sure that you're working with operators that are aware of those. So a couple questions here. Let me go back. So someone asked, right here, it says, can you still do a cost segregation if the 1031 didn't work out?
You can do a cost segregation study if you did 1031. The only requirements for a cost segregation study is that you got something to segregate. So it's not one or the other. The only difference with the 1031 exchange is you're carrying over your basis from your old assets. So it doesn't provide the same benefit that it does if you didn't do a 1031 exchange.
Awesome. And then one of the questions here, and we keep getting this question, is when is the cost segregation study initiated and by who? So that is something that the management team, they take care of that. So after we close on the property, that is when we schedule the cost segregation study. And again, that's something that we take care of on our end. We pay for it, we get it taken care of. So really the only thing on our passive investors side is obviously they have to talk to their tax accountant, make sure that their tax professional understands the situation. But then when we give them the K1, your tax document at the end of the year, that will include your depreciation so that you can take that and really apply it to whatever situation you have. So this isn't, adding to your list. As a passive investor, this is something that we take on as operators to make sure that you can benefit from. So I love that question. The other question I have here is how is cost seg applied? Oh, by the way, there are quite a few questions in the Q&A area that is all about single family. Obviously, we here on this channel, I want to be respectful of everybody's time. So we're not going to dive into single family. If you have specific questions, you can ask a tax professional, but those ones I had to skip over. So this one says, how is cost seg applied to assets where not much CapEx is performed? For example, a stabilized property.
It's the same. So all you're doing is you're pulling out shorter lived assets. So it doesn't matter if it's, with CapEx, you have an additional, so there's cost segregation studies and being able to segregate the assets. And then there's CapEx, which allows you to use tangible property regulations, which is a completely different topic, which gives you even more benefit. But ultimately, even if it's stabilized, I mean, if you buy a completely rehabbed property, it still has refrigerators, dishwashers, whatever it might have, and you get to pull that out from the purchase price. So it won't change at all.
And Steve asks, where he is a passive investor, I assume this question is, can I still do a cost segregation? So my understanding is no, as a passive investor, and it's quite expensive. So you wouldn't want to. We take care of that. But if you're involved in a property that the operators are not doing a cost segregation study, Tim, are the passive investors able to do one on their own?
No.
Okay. Perfect. Now, here's another one that was really good. It says, if you have 25 investors, how does each investor get tax benefits from the same property? Is it divided by your percentage of the ownership, or how do you divide that?
It depends on how the operating agreement is written. But typically, most operating agreements are written in a way. So I'm trying to stay high level and not get down into the tax weeds.
Which is hard.
Yes. So every tax allocation under 704, which is the code for partnership allocations, has to have substantial economic effect. And so what that really means is you've got to money has to follow income, and loss has to be allocated to people that have risk of loss. So in most operating agreements, well-written operating agreements, the losses will be allocated to people that have capital first, and then pro rata based on membership interest. And so ultimately what it looks like is, if it's based on risk of loss, 100% of losses go to people that have capital. And then once that's been exhausted, then it goes to everyone based on their membership interest. It doesn't have to necessarily be that way to have substantial economic effect. The IRS says it just has to be done based on membership interest. So it could be based on whatever your interest is in the partnership. So it really depends. But in most cases, it is based on membership interest if it's not based first on people that have capital accounts. I know it's confusing. Sorry.
That's okay. You have to explain it a little bit. I mean, we can stay high level, but there's some of these questions are a little more granular. So here's this one from Neil, who is a current investor of ours. He says, what are the advantages and or disadvantages of investing inside a traditional or Roth IRA?
A Roth is, I mean, a Roth, you're avoiding tax throughout, but the problem with, so anything that falls out of code section 401, which a 401 is traditional 401, anything of that nature. So think of a 401k plan that you have as an employer or at a job as an employee. An IRA, a Roth IRA, all of those fall out of 401 and they're subject to UBIT tax or UDFI. So unrelated debt financed income. So there is a portion of a gain that would be tax-free, but what a lot of people don't understand with IRAs and Roth IRAs is that if there's any debt or any income generated from other people's money, that income is going to be taxed. So really, when it comes to real estate, there's not a huge amount of benefit to investing within a traditional or Roth IRA.
Okay, that's perfect. So Dave just asked this question again. He said, do you have to be part of the GP to benefit from cost segregation, or can you still participate as part of the LP? Yes, you can participate. So obviously it does depend on the operating agreement. In fact, I do remember seeing a question over here in the chat that said something about, I know it was from Steve. Now I can't find it in here. There are too many other questions, but it ultimately was asking, is that something that GP members disperse to their investors, or do the passive investors have to ask for it, or how does that work?
So, and this is something that I hear a lot. A lot of sponsors talk only about bonus depreciation. Bonus depreciation, bonus depreciation. Investors are going to get all of the bonus depreciation. Bonus depreciation and depreciation is just an expense. So it's no different than marketing. It's no different than repairs. It's no different than management fees. It all gets lumped into one number, which shows up on box 2 of your K1. So that is going to be allocated based on the operating agreement. So it's not going to be it's going to be allocated the same way that interest expenses, all those other expenses are going to be allocated.
Awesome. Hopefully, Steve, hopefully we answered that. I couldn't find the exact question, but I'm pretty sure it was something like that. So I feel like we've answered a lot of these questions. Now, I've seen a couple people ask what your contact information is for your firm. So just a reminder, this is where it would be the best, easiest, most smooth way for the investor to really get in touch with Tim's firm. If you go to the website, provisionwealth.com, and click on contact, that will be the best way for you to really get in contact with his firm. So I'll go back there. But I did have to skip over quite a few of these questions just because a lot of them we could get into this topic for hours. So, right, Tim? I mean, there's so many different rabbit holes that we could go down. And so we wanted to really focus on really the difference between 1031 exchanges and cost segregation studies. So that's really why a lot of these questions were not answered, and I apologize, but I tried to make sure we answered most of the questions that referred to this topic. If you still have questions, feel free to reach out to Tasha or I. I know that Tasha has added a couple different links in there. Feel free to reach out to us. We are more than happy to jump on a call and really discuss this. But at the same time, you do need to talk to your tax professional, because again, this is such an in-depth conversation that you need to talk to somebody that is familiar with your situation. So we can talk about, as general partners, what we do on our deals and what we're able to provide. We can talk about that till we're blue in the face, but you still have to make sure to communicate with your tax professional. So I also have seen a couple questions asking about the copy of the recording. Absolutely. This recording will be sent out. I'm sure that you guys noticed that a little bit into the presentation, the recording was turned on. Y'all, that was my fault. I usually have Jackson on here, and he had to run to a meeting and he put me in charge. Y'all, I forgot to record it. So thankfully he came in clutch and started recording earlier this meeting. So yes, you all will get the recording. Hallelujah. We all need to send him some chocolate. But absolutely you'll get the recording, but please reach out if we can help answer any questions. Again, this is the QR code. If you scan it with your camera, it will take you straight to a soft reserve, or you can let us know how much you're thinking of investing, and Tasha and I can help you really work through that process. So Tim, Ryan, thank you guys so much for jumping on and really diving into this topic with us. So helpful, so grateful for you. And I know that there were a ton of comments in here saying that their thoughts and prayers are with you, hoping that you get feeling better and to really kick this whole COVID bug.
Definitely. Thank you. Thank you guys. One last thing I wanted to throw in, if I could.
Of course.
And it goes into ticks. I know Ryan loves ticks. But so here's one thing that a lot of people don't talk about with 1031 exchanges going into syndications is the only way for that to work is you have to be a tenant in common. And what that means for a passive investor is now you have to be involved. That means that you have to report all of the income and expenses and report your share of the assets. You have to report your share of the debt on your tax returns. You have to be present to sign documents. You have to be involved with closings. You have to be involved with refinancing. You have to do all of that. So you're now taking yourself out of the role of being a passive investor to being someone that has to be front and center and involved with the aspects of a property that you're not going to control, because there's going to be a TIC agreement that says you have no control of that property. So all it's doing is it's taking you out of being a true passive investor and making you have to actually put time and effort and reporting requirements and tax filing requirements that you wouldn't have to do if you didn't do a 1031 exchange and put into a property that did bonus depreciation through cost seg.
You know, Tim, I remember you told me one thing too. It was like the value of $1 today is better than the value of $1 we don't know what in the future, right? You know, I think that's just the best way that you could ever put it, right? Is you don't know what it's going to be. I mean, we could get into the whole political part of it, of what's going to happen potentially in the future. You and I have discussed this briefly, but you know, I mean, why not take advantage of what we have today and the options that we have? And this is what, you know, getting a good qualified person like Tim and his team, and a good accountant, to your point, Gene, of people who can help take advantage of these things and get you the most write-offs, right? And utilize these depreciations. I see so many people that still go to H&R Block and it kills me, right? Not that they're awful, but they're just not going to get you, you know, the best appreciation or write-offs that you can get. And someone mentioned in here, you know, get someone who stays up with tax code and tax laws, right? You see a lot of people that don't keep up with that, so they don't know what's around the corner. You know, Tim has always said that there's always going to be something, right? It's a matter of people like Tim and his team that keep up with it for us. So we appreciate everything you do, Tim.
Thank you.
Absolutely. Well, we want to thank everyone who jumped on and stayed with us this whole time. Thank you for your questions and your engagement. We love to answer your questions, so thank you so much. But again, thank you to these gentlemen who joined us this evening and gave us all this valuable information. So please reach out if we can help with anybody or anything, but please everyone have a great evening and let us know what we can do. Thanks, you guys.
Yeah, appreciate it, guys.